Hello, everybody, and welcome back to my new channel on quantitative oil trading. Second episode. Today, we're going to discuss the algorithmic oil traders. As I explained in my first episode, they are probably the most important and the most profitable traders in the oil market. So today, we're going to dig a little bit deeper into how they actually work and probably unmask and uncover some of their mysteries. So what I'd like to do in this series in general, I'd like to use my following videos as an opportunity to answer some of the questions. And I'm really glad that a few of you pointed out to some of the typos that unfortunately I had in my first inaugural video. So I'd like to kind of remix the last slide where we ended the first video and make one small correction. So if you recall that slide, that's where we ended last time, that the most profitable traders were so-called fast. When I was defining fast, if you recall, I defined them as a residual between the managed money and slow, and I had a typo here, which I now fixed. If you recall, slow was a proxy for the pension funds, which generally tend to have long positions. As you can see, they're not making or losing much money. Their overall P&L over the long history is about zero. However, the fast, which I associated with quantitative traders, they are quite profitable, and they were generating a sharp ratio above 0.5 in WTI and Brent. And now we're going to move into who they really are. Let me start whenever I like history, and whenever it's relevant, I'd like to give you a few historical tidbits. And I think this one is particularly fascinating to me. There is a lot of folks that claim to be the pioneers, or one of the pioneers, quantitative or technical trading. We're not going to get into this debate. It existed for a long, long time, perhaps as early or maybe even earlier than 17th century. That's in 18th century. There was the first book that I know written by the Japanese candlestick rice traders. So that was kind of a technical quantitative analysis. But one story I'd like to share before we get into more specific technical stuff is a bit of a story of the Commodities Corp. It's probably one of the first legendary commodities quant fund, which was set up in late 1960 in Princeton, New Jersey. It was set up by the gentleman named Helmut Weimer, who wrote an absolutely gorgeous, great PhD thesis in 1965 on fundamental cocoa trading and the theory of storage. It was actually one of the first quantitative series of storage that I encourage people to read. There is an interesting paper that he has written as well. His advisor was actually Paul Samuelson, the first American Nobel Prize winner in MIT, and Paul Kuttner, the author of the popular book, The Random Character of Stock Market Prices. So what happens, he basically wanted to make money off his dissertation, so he set up a fund, even though Paul himself was kind of skeptical about his effort. So he decided to participate as one of the seed investors in the fund. And I think Paul Kuttner was involved as well. There was a lot of famous folks who were basically around him at the time. And I really appreciate that they were actually very experimental in nature, and were willing to essentially put some money into that effort. But what's perhaps less known, and that among the junior traders in that fund or associated with that fund were folks like Paul Tudor Jones, who now basically manage the multi-billion-dollar Tudor fund, or Louis Bacon, who managed and owns More Capital, and Bruce Kovner, who owns Caxton Associates. So they became legends in their own rights, and these funds are still in the industry. So, and they all started their career by being involved in that fund. Now going back to the technical analysis, the original idea of Weimar and his colleagues was to trade fundamentally. And then we'll see throughout the lecture course that in fundamental trading, more often you tend to buy low, sell high. and trying to, because the idea was that the commodity markets are cyclical. So what basically goes down should go up, and what goes up must come down. That's kind of the idea, really. And that's supported by the theory of storage. Well, unfortunately, it wasn't really working for them. So they were losing money by trading fundamentally. So, and finally, good that they had some kind of a risk management system. And the risk management systems that they set up started to penalize traders for basically betting against the trend. And in a couple of years, they realized that the risk management system by itself is making a lot more money than all the discretionary fundamental traders. So they basically shut down the fundamental trading, and they just started to trade their risk management system as a trading strategy. And that's probably became one of the first, if not the first, proper quantitative trend following system in the world. And they became incredibly successful, made a lot of money for nearly 20 years, and they finally sold themselves to Goldman Sachs. It became Goldman Sachs Princeton, and subsequently it sort of evolved into a department of one of the foundational blocks, in fact, of what's now called Goldman Sachs Asset Management. A really fascinating story, and I think they do deserve credit. You can read more about them online. There is a couple of interesting articles on Wikipedia, which I also cited in my book. But that's a history. So, like, why commodities? So the commodities are very attractive for running diversified trend following system. There are basically a lot of them. They have idiosyncratic risk, great for diversification, extremely easy to leverage because they're futures. It's as easy to sell them as to buy, unlike some of the equities. They have huge fat tails. There are a zillion of reasons why you should be trading commodities. Subsequently, this industry evolved into what I call diversified long-short commodity portfolio, which generally trade either in a time series or cross-sectional frameworks, which I explain in more detail in one of the subsequent videos. It's not the subject of today. And energy futures are always very important in this diversified portfolio because it's the biggest market, the most liquid one, and generally it has a large contribution to the performance of these diversified commodity portfolios. So it's really, remember in the previous video, I mentioned that the quant funds are really after capturing this risk premium, which became dynamic. The two primary commodity risk premium are momentum and carry. And in the equities and financial markets, there are many explanations why momentum exists. Very behavioral, typically, but in commodities, it's much simpler. In commodities, both momentum and carry have their roots in a theory of storage, which, again, I will cover in more detail in one of the videos, but you can consult my book. It's in the very beginning of this because it's a foundational piece. So basic idea is in the short run, inventories tend to trend because supply and demand are inelastic. So if supply exceeds demand today, most likely it's going to exceed tomorrow and the day after tomorrow. So you got, if supply is bigger than demand, inventories are building. So therefore, because they're inelastic, you got a trend in inventories. And by the theory of storage, if you got a trend in inventories, it generally translates to trend in prices. That's a sort of the foundation mental model behind momentum. And carry is even more direct, and I'll explain you in a couple of slides what's a linkage there. So momentum, many ways to define it. I think the simplest way, you take price today, you subtract moving average, which depends on a number of observations. So the standard one is momentum 20, which is basically 1 month's momentum. Basically compare today's price versus 1 month's moving average. Then you buy it if that difference is positive, you sell it if the difference is negative. So very simple strategy. You can probably implement it in 20 minutes in Excel. Here is a shocking result. Well, it's not really shocking. It was shocking a few years ago. But if you run this strategy over the last 30 years, you generate very kind of okayish 8% return over 30 years. It was much higher, actually, if you did this analysis a few years back. And it has some positive Sharpe ratio. It's not hugely significant, again, but it has some informational content. So you can see the performance by year. It used to work really well, but last couple of years, it's actually struggling. We'll get to that in a minute. But still, people can use it. There are various variations of momentum. You can turn it into a crossover of moving averages. You can apply it for multiple frequencies, breakout, threshold, all kind of stuff. But the important thing that why people use still momentum, a lot of momentum strategies, specifically in oil, is marketed as part of their crisis alpha portfolio. So the basic idea here, if you basically plot, for example, on the horizontal axis here is a return from owning and rolling oil futures, and on the vertical one is returns from investing in oil momentum strategies. So the graph looks like kind of like a smile, but it's a very small, like a smirk actually than the smile, because the left side is much steeper than the right side. So what it's really telling you, when you're struggling on a directional position, the momentum strategies have a home run. So effectively, every time you lose like 50% on holding directional position, momentum strategy covers it. And there are graphs like this where you can put like an equity market here as well, got a very similar sort of momentum smile phenomenon. And oil is a key component on that, because basically, whenever you got some geopolitical crisis, I'm sorry, not geopolitical, macroeconomical crisis and everything goes south, oil tends to go south really quickly. So oil momentum makes you a lot of money. So it's effectively a hedge. That's why, even though the performance is not fantastic, it's effectively a hedge. And a lot of folks are still investing in that momentum strategy. Now, carry, much better strategy. And then carry can be defined in many different ways, but the standard way, carry is basically the slope of the futures curve. So you can pick a couple of futures contracts on the curve, take the difference, and if the market is downward sloping, the carry is positive. It's an upward sloping, it's negative. So generally, it's not really, it doesn't make huge difference which contracts you pick, because curves tend to be, backwardation tends to be convex, contango tends to be concave, so it basically doesn't really matter what you pick. There are sometimes, occasionally, the curves are humped, or like now, it's more like smile. Then you have to be a bit more selective. But generally, I would say the standard one I usually use non-seasonal carry, which is month 1, month 13, or if you want to step away from the front, just to avoid expiration games, use months 2, 14, or months 3, 15, something like that. So again, the carry, if you basically run the basic carry strategy where you carry is defined the sign of, so the signal is defined just the sign of this difference. So you buy when the curve is backward, sell when the curve is contango, you got nearly 20% return over 30 years, just one commodity. It's not bad. And the Sharpe ratio is 0.5. So why does it work? It's a really simple strategy. And besides, unlike momentum, that's crucial. Carry is model free. Remember, in the momentum strategy, you have a parameter here, N. And if you do like a crossover momentum, you got more parameters. So it's very kind of actually unstable. And I describe in the book in great detail why momentum naturally is much more unstable than carry, and it's basically very prone to overfeeding. Carry is not. Carry is effectively model free, because you're not using any history here. Don't have any parameters. All you're doing, you're basically looking at today's shape of the curve and you buy and sell. So why does it work? Well, the reason it works, again, it goes back to the theory of storage, because if you're in the contango market, then if you remember from the first video, the largest trader in the oil futures market is an inventory hedger. So if you're in the contango, what the inventory hedger does, the inventory hedger buys here in the spot market, and sells futures, as long as the difference between the two covers the cost of storage and interest rate, then effectively it's a free money. So they're not speculating on the market, they're not doing anything. So we don't see what they're doing in the physical market. That's kind of hidden behind the curtain. But what we do see, as long as the market is contango, they're going to be selling futures. And that persistent pressure on selling futures, that's what creates a trend. As long as you're on contango, they're going to be selling futures, and they're the largest market participant. And now if the market flips backward, or technically if the difference becomes less than the cost of storage, then you basically gonna take oil out of your storage, sell it in the open market, and buy back your futures. So you're always gonna be buying futures in the backward market, and you're gonna be selling futures in the contango market. That's what the physical inventory hedger is gonna do. As a financial trader, what you're doing, you basically just front-running the behavior of the largest market participant. So you're going to be doing the same thing, even though you don't have any storage. But since you know this is what the largest market participant is going to do, you're just going to do the same thing. It's really just front-running their behavior. And that's really why it works. The only, well, not the only, but one of the main issue with storage, it's a bit, with carry trade, it's a bit slow. In other words, the contango and backwardation don't flip very often. So, for example, we have been backward for a couple of years already. That almost results you in holding a static long position. Or prior to that, we were in contango for nearly half of a decade. So it's very slow. So what you want to do, you want to speed up a little bit. And this is one of the areas where quant funds really develop some unique skills. So it's called signal blending. And signal blending is not necessarily just adding two signals together or allocating half of your capital to each signal. The blending can be done in multiple ways. And here is an example of how just one example of how the signals can be blended. So here, what we're going to do, so we're going to apply the momentum to speed up the carry. In other words, we're going to apply momentum directly to the term structure of futures. So we're going to basically measure carry today. We're going to calculate the moving average of carry. Again, use 1 month moving average. Subtract the two. If the carry today is higher than moving average, you buy. If it's lower, you sell. So what that means is if market is backward, but the backwardation is becoming steeper, you buy. So if market is backward, but the backwardation is becoming flatter, you sell. If the market is contango becoming steeper, you sell. And if the market is contango, but contango becoming flatter, you buy. So why would you do that? So the idea here that carry reflects kind of as a state of the world. So if the inventories are high, we should theoretically be contango, but everybody knows it. So what the market trades on, not based on today's state of the world, but rather based on future expectations on where we're going. And what this signal is trying to do, it's trying to see some changes in the shape of the curve and use them as the proxy for market expectations of where we're going. So that's why we are applying, if the forward curve is a proxy for the inventory changes, so for inventory levels, then the changes in the forward curve can be thought as a proxy for market expectations about the inventory changes. So that's the idea. So if you run that strategy over 30 years, again, use always 30 years in my, for this presentation, you got nearly 25% annual return over 30 years, not too bad. And the Sharpe ratio is even higher. And besides, it minimizes the drawdown quite a bit. So that's kind of the carry momentum strategy really plays a pivotal role in many of the systematic trading trading portfolios. And of course, you can try it for other commodities as well. It doesn't work as well for many other, but in oil specifically, it works particularly well because of the large role that storage traders play in the futures market. And the other way to blend signals is to apply the so-called reaction function. That's another fundamental piece that that quantitative traders use. So the reaction function is basically how do you size your position. So it's not always optimal simply to buy one unit and sell one unit when you got trading signals. So there are many ways to size your position. And a lot of folks, such as risk parity, for example, like to size it inversely with the volatility of the market. In that case, on a volatility adjusted basis, strategies have equal risk deployment. However, more advanced traders among quants, they tend to size their position with the strength of the signal. And we used to do it as well. So in a sense, you bet only while the deck is rich. You don't need to bet the same amount of capital at all times. So you want to bet more or less depending on the market conditions. And here is how you can kind of blend it into one signal. So you apply something called a reaction function, which looks like this. We'll actually talk more about it in one of the videos when we're gonna use a neural network. So it's kind of similar to neural activation function in a sense. So it could be non-linear, it could be piecewise linear. So I kind of like it particularly this one. So what it does on the horizontal axis here is some normalized strength of your signal. Think about it, for example, momentum on carry. So the unit of one, you can think about it as one sigma, one standard deviation too strong. So in that case, you set up your signal where you deploy 100% of your capital when your signal is 1 sigma too strong. And then, for example, in case of momentum, so you don't want to be buying too much when the signal is way too strong, because in that case, you probably already pushed, or the market already moved far away from its average or from its normal zone. So the likelihood that the market is going to correct increases. So it's becoming more dangerous for you to buy the highs and sell in the lows. So you actually start decreasing your position. And that is kind of a very critical pivot point, a fundamental block also in the CTA's positioning. How do you draw this line? And then we'll talk more about that when we try to replicate the CTA's position in one of the subsequent videos. And then the final slide for today, I just want to say a few words about alternative risk premium and the value risk premium. In the equities market, people tend to use three: momentum, carry, and value. And then value in commodities hasn't been working well historically, but things it appears to be changing. So I'd like to spend a little bit of a few minutes on that, because while it wasn't the past, it could well be the future. So value is effectively betting on mean reversion. You're trying to buy low, selling high. In the oil space, it's very hard to define value because there are constant changes in technology like shale, or demand pattern like electric vehicles. So there is no one number that you can use for value. For long term, you can kind of use marginal cost of production as value, which is not bad. But short-term value doesn't really exist, because in the short term, and again, we'll talk about it when we discuss theory of storage, there is really no boundary, at least on the upside. If you run out of stocks, there is no real boundary on value. The problem with value, in a very simplistic way, you can define it as the opposite of momentum. However, you want to trade it a little bit with a different horizon. While momentum is a fairly fast thing, value requires, you need basically more time to things for normalize. And again, it's coming from the theory of storage. Then eventually supply and demand gonna get rebalanced, and you're gonna converge to some sort of a long-term average. But you do need more time. So in fact, you don't want to trade it as an opposite of momentum. The standard way to define value strategy, you want to trade it above a certain threshold. For example, if this difference between price and moving average exceeds a certain epsilon, you sell. In other words, it has to exceed. In other words, if today's price exceeds a moving average by more than epsilon, and you can define it, then you sell it. And if it drops below a certain threshold, you buy it. But in between, you do nothing. In other words, you want the price to be substantially high relative or low relative to moving average before you do anything. One of the biggest problems why value didn't work, because you always face the negative carry. So let's say here is an example of a standard contango curve where we are typically in concave contango. In other words, the slope is steeper in the front than it is in the back. So if you really try to capture buy in the lows in the front, you're gonna face a very steep negative carry, because you can buy it here, but most likely you're gonna roll down because you know already that the carry strategy works and you're taking the other side of it. So if carry works and you're taking the other side of it, then you're gonna lose money. So yes, eventually you're gonna get it right and you're gonna buy the low and then make this money. Let's say this is a long-term average. But by the time you do that, you're gonna lose so much money by facing negative carry, then it's almost a negative return strategy. So one way to do it, you move further on a curve. Instead of buying it in the front, you buy further down where the slope is steeper, negative carry is steeper, flatter, or not as strong. Then in this case, you're no longer trying to capture that much money, you're trying to capture less money, but it's less risky as well. So this type of strategies are kind of beginning to work better, especially more recently we have been in range-bound markets. But in general, the basic philosophy here for directional trading, you tend to use carry and a little bit of momentum with some signal blending. But where value works very well is for trading commodity pairs and some statistical arbitrage strategies, which we're going to record the full video on that at some point. And real quick to wrap it up on other academic, there are a bunch of other academic risk premium where people use hedging, speculative pressure, liquidity, open interest, skewness, kurtosis. None of that stuff really works in oil. And I'll explain again at some point why. However, the hedging speculative pressure, we tend to call it in trading positioning analysis. It can still be useful, and maybe that's going to be the subject of my next video. But because there is some informational content, you just need to use it prudently. And finally, one important risk premium, which we're going to cover in great details, is the volatility risk premium. That's very specific to the oil market, and it's probably one of the best performing quantitative trading strategies, but it does require options. So this is my second video. I hope you found it useful. Again, I'm a fairly newcomer to the YouTube channel. So if you subscribe, leave me feedback, contact me in any other way. If you found any errors, typos, by all means, reach out. And thank you very much. And I'll see you with video number 3 shortly.